Concern is the materiality, that inclusion and disclosure of financial transaction in financial statement hinge on their size and effect of the companies performing them. It will disturb. You got to be aware as to what is our materiality threshold is. Now, you purchase a calculator, you pay for 120 reals, and this calculator living in this office for the next 20 years, this 120 reals you're going to capitalize or you're going to recognize as expense. You will recognize as an expense. But if you really go back to our original discussion of assets, an asset will bring economic benefits over a period more than a year. Then I should consider that as fixed asset. But this calculator, I only paid 120. Then we then have another concept developing, threshold, materiality threshold. What is the minimum threshold that you have? If $5,000 reals or above, I capitalize. Anything less than 5,000, simply take it to profit and loss account. So then conservatism. Financial statement should be prepared with the downward measurement bias. Assets and revenues should not be over. I would give another name to this. Prudence. This is prudence. When preparing financial statement, we should be preparing with a prudent mind. Financial statement should be produced based on the prudence concept. Let's say the shareholder tells you, I need my company to be very beautiful. Then what you do? You revalue all your assets, left, right and center. This 500 real, you put it as 10,000 reals. So you have a surplus of how much? 9,500. And let's assume you have 1,000 pieces like this. What will happen to your company? Your company will become a very fat company. Shareholder, you try to make him happy. You show him a rosy picture. Simply what you have done, you have overstated your assets. Yeah, too much expense is something else. You have overstated your assets. When you have overstated your assets, and is it happened realistically? No. Then it's like balloon. You know, when you blow the balloon, blowing and blowing and blowing, at one point you blast. Is that clear? Yes. So you cannot do that. And also, you must not be you should never be understating your liabilities. That is another fact to pay attention on. Now, up to now what we discussed is framework. In Google, if you search framework for financial reporting, you will find a PDF, pages running into maybe 300 or 400 pages. And I would encourage you to spend some time reading it. I will try to download and share with you. I will do that hard work for you. But your hard work is to read. Okay? So now IAS 1. This is the official first accounting standard in our journey that we are going to discuss. What we are going to discuss here, an entity shall apply this standard in preparing and presenting, underline the word, general purpose financial statements. That's very important. See, if you talk about industries, insurance is one industry, banking is another industry, leasing organizations are another industry, then government entities are different industries. When producing financial statement for these, ignoring the different types of industries, what could be a financial statement for a common business? That's the word we call it, general purpose financial statement, and in accordance with international financial reporting standard. Does not apply to interim financial statements, and it also not apply for consolidated financial statement. Why? Consolidated financial statement, we have a separate standard, talks about IFRS 10. Later, we will discuss in full. There we will see how we prepare that. So, IA is one applicable for the general purpose financial statement produced in accordance with international financial reporting standards. Those intended to meet the needs of users who are not in a position to require an entity to prepare reports tailored to their information needs. That's what I was explaining you. It is not for insurance. It is not for leasing. It is not for hospitality. It is standard. Then you tailor according to your needs. Now, who issues IFRS? These people, IASB. And these comprise of International Financial Reporting Standards, International Accounting Standards, and International Financial Reporting Interpretation Committee. To give an example, this Muslim people will understand easily, and non-Muslims might find it little difficult to understand the example I am going to give you. Now we have Hadith and we have Quran. In order to make this Quran and Hadith, some people went on to explain additional explanation. We call it tafsir. So, correct? Yes. So this international financial reporting standard, same like Bible. You can think Bible. And the last one is an additional explanation as to each and every item that you found over there. So that is Ifrs. Now, a layman like you and me, when I read the International Financial Reporting Standard, I may not understand fully what are the related terms and conditions there. And then they went on to introduce another document. Okay, my friend, read this, you will understand. So that is Ifrs. In short, we call it Ifrs. Before actually it was what you call that Accounting Standard Representation or Interpretation Committee. Now this became IF. Now what are the purpose of financial statement? Financial statement will give you a snapshot, and that will give details of assets, liabilities, equity, income, expenses, contribution meaning dividends or drawings, and the cash. Now also I want to tell you, sometimes I would assume that yes. So what I wanted to say, sometime I would continue to discuss and I will make an assumption that you understood. If you please don't understand, raise the question to me. So financial statement, five captions: income statement, statement of financial position, cash flow statement, statement of changes in equity, and every single financial statement you will have these sections. I'll try to share a common example of a financial statement which will make you understand better. So what are the general features you would see in a financial statement? The financial statements are prepared on a fair presentation, and all financial statements mandatorily should be complied with IFRS. And also remember, it is not only complying. You should say that I am complying. They are saying that the auditor should be independent. Fine. Auditor should also be deemed to be independent. And auditor should also appears to be independent. It is not enough to practice independence. It is also important to tell others, look, I am independent. Same story. You prepare financial statement according to IFRS. And in the financial statement, you write a note saying that this financial statement has been prepared in accordance with IFRS. Why? If you go to US, they don't follow Ifrs. They follow US GAAP. And some other countries, Saudi, currently they are in the process of preparing financial reporting to Ifrs, but still now they are following SOPA, Saudi Organization of Certified Public Accountants. So, if you read the financial statement from these countries, you would not see compliance with Ifrs. So that's one important thing. And we prepare financial statement based on one assumption. All the financial statements are on the valid assumption of going concern. What do you mean by that? The business will continue for an unforeseeable future period without having an intention to close down or to curtail its operation severely. That's why you categorize your assets as to current and non-current. And you categorize your liabilities as to current and non-current. Understand me? So, then materiality and aggregation. Now, sometimes it is allowed to aggregate. Sometimes it is not allowed to aggregate. Good example, let's say I am an agency business. You are the principal, I am the agent, she is the customer. So I buy items from you, 100 riyal, and I sell with a commission of $10. So I sell for her 110. Actually, what is my income? This $10. So, if you net it off, only the income of 10, that netting off is not accepted. You got to show separately the purchase cost of 100 and the revenue of 110, and therefore your profit of 10. So that is based on the case to case. You are allowed to aggregate, and sometimes you are not allowed to aggregate. And offsetting. You are a customer and you are a supplier. You need to pay me 1,000 riyals and I need to pay you 1,500. In effect, how much I need to pay? Only 500. So in the financial, I am not allowed to show that payable of 500 to Mr. whoever. So what you need to do? You need to show receivable of 1,000, payable of 1,500 in two different headings. Then frequency of reporting. What do you think? How frequent we should report our financials? At least minimum every year. Then comparative information. Previous year financial information should be presented along with current year financial statement. Why? People need to understand on a comparative thinking. Clear? And then consistency. Financial practice must be consistent over the years with the same company and within the group with the different entities. Fair presentation and compliance. Financial statement should be presented fairly. You cannot have unfair presentation. Financial performance and cash flows of entity. Position, performance and cash flow. Position is balance sheet, performance is profit and loss account, and other one is obviously cash flow. Faithful representation of the effects of the transaction, other events and conditions in accordance with Ifrs. With additional disclosure when necessary. There is something called contingent liabilities. What do you think? What is that? Anyone can tell me what is contingent liabilities? We use this word on a day in and day out. Contingent scenario, contingent case, contingent liability, contingencies.
First in, first out.
First in, first out? I will search the gun, I will shoot you.
I could show in the
What is contingencies? I'll give you a small example. You in your house, you have parapet wall. Everyone knows this, right? Parapet wall. You have the house, the surrounding you have a wall. You see one cat sitting on that top of the wall. Now you tell me he is going to jump inside or outside. Can you say that? No. We cannot say. But for sure we know one thing, he will jump. But he will jump this side or the other side, we don't know. The how do you call this? Future uncertain event.
Yes.
The outcome of which may be favorable or unfavorable. This is what we call contingency.
Predict the future.
We cannot predict.
Predict the future.
You know, tomorrow, this
Tomorrow is
meteorology department. Tomorrow they will say about the weather forecast. The rain might come or might not come. Same story, contingency. Now, if we have any contingency situation in our company, we need to present that. That's why we always talk about faithful representation.
Just like the suspension